I'll get started now. Thank you so much for joining. Next slide, please. Today's focus is investing in the ever-evolving landscape of Gen AI and AI ML broadly. I'm really happy to have two great friends and investors join today, James Wu from First Round Capital and Jordan Windmueller from A-Star Capital. And in a bit, they'll give a bit more background about themselves and their firms and investment theses, and then we'll get into the questions from there. We're hoping that this will be more of an open Q&A format, so feel free to ask questions and we'll outline how to do so in a bit. Before we get started on the actual webinar, I'll go through some logistics. Next slide, please. For all our partners, this webinar will be recorded, and so it can be available on YouTube and/or under the resources tab in your partner portal. So we save all webinars afterwards and we send links to the webinar itself. And we got a few upcoming webinars in the coming months. Next slide, please. So as a brief reminder, OUP, we're a venture fund that invests in university spinouts, typically by exercising participation rights in our partner universities. The relationship with our universities is that we share our carried interest by assigning the participation rights. And in return, we provide services such as webinars, training, funding activity, hiring, and strategic partnerships across the board to their existing startups and budding startups. Since 2009, OUP has made over 140 investments in university spinouts, part of which include AI and ML. Since then, we've had 30 IPOs, a number of acquisitions, and we're about an 18-member team. Next slide, please. And so the agenda for today, I'll give a quick primer about Gen AI and venture capital, the state of the fundraising environment. Then I'll hand off to my panelists, First Round and A-Star, and then we'll get into the Q&A. And in terms of logistics, we have both a chat and a Q&A function. If you could have any questions, please feel free to use the Q&A chat bot. I'll try to get through the questions as soon as possible if you post it there. Next slide, please. So as we all know, past 2 years have been a little crazy in both our personal lives and investing lives. A lot of it has been due to the impact of generative AI and large language models. And so I'll just give a brief primer so that we could set up the conversation and to illustrate how we as investors think about the space. Next slide, please. So without getting into the technical details, but providing a high-level overview of the space, the foundation of LLMs have been basically created by decades of NLP research from the days of IBM onwards. But it wasn't really until fairly recently that the explosion of the capabilities have been evident. So in 2017 at NeurIPS, Google released this paper called Attention is All You Need. And ultimately, in simple terms, improve the performance of these large language models to the degree in which they could, increase the size and knowledge and understanding of context of text to be able to predict the next letter significantly more accurately. And as a result, it exploded the industry. And so in 2020, OpenAI released GPT-3, which is an LLM that had 175 billion parameters. And although most folks didn't have access to it, I think if you're on Twitter, you'd remember the number of posts that were coming out about how incredible these tools were. And so that started the first explosion of app layer ideas like Jasper and others that were leveraging the API and using its capabilities. But I think we all know where we were when ChatGPT released in the end of 2022. It wasn't until an accessible UI made it possible to understand exactly the value of these tools. And so as a result, it was a whole new gold rush as we know it. Now, in terms of technical terms, after GPT-3 was released in 2020, OpenAI released GPT-4, which is a 1.7 trillion parameter model. So about 10x the progress and size increase, and comparatively the cost of training this model as well, which was reported to be around $100 to $150 million. And so if you notice that the rate of progress grew exponentially from there. And so the underlying thesis is that the scaling laws will prevail. So the larger the model, the larger the computational power, the larger the predictable performance of these capabilities. And we're reaching a point in time that, perhaps, are we reaching a plateau? Because there might be just a given point in which we don't have enough resources or capabilities to keep training this thing. And so that's an underlying question that we as investors and others constantly think about. The rate of progress has been tremendous in a few years. And now where do we go from here when we have Claude 3 and GPT 4.0, which are at these 2 trillion parameter models? And there's all kinds of theories about what's next, whether it's smaller models or whether the scaling laws will prevail where we spend $1 billion training a model. So it's a huge question in our industry. Irregardless, next slide, please. Irregardless from an investing standpoint, since ChatGPT released, it sparked a huge funding frenzy. So you can see, besides the news, the round sizes are immensely huge. So about a few months ago, OpenAI announced the largest venture funding round in history of $6 billion or so. And so that speaks to the enormity of the challenge. Creating these models that'll fundamentally, ignite this entire industry. And ultimately, this is a new funding gold rush. And we as investors are trying to determine where is the alpha within the space. And so next slide, please. As investors, especially in a fast changing world, what we're trying to do is make sense of it and to understand where we should spend our time and resources. And so pretty quickly, all of us had to figure out how to make sense of these foundation models and what are the emerging opportunities. At OUP, we created this sort of framework to be able to understand it. And I think it's universally applicable, regardless of whether you invest in university Spinouts or not. And so at the base layer, there's this hardware segment. We've all heard of NVIDIA and their chips and their GPUs and how important and instrumental they are towards training these models and running them on inference over time. But there's a whole host of different chips and segments that improve data center performance, which is ultimately a requirement for LLMs. In the infrastructure layer, this is the middleware software that either protects or ensures safety of the models themselves, or trains them at a much lower cost, or runs inference at a lower cost. And then you have the foundation models themselves, which have mostly consolidated. So OpenAI, Anthropic, and a few others have raised monster rounds. They've continuously released models. And I think, as a new startup, it's quite hard to compete in this sector without significant capital. And then now there's an emerging segment of application layer startups. So they're leveraging all of the base layer tools in order to, disrupt emerging industries that are, completely, susceptible for disruption for these type of tools. So Harvey is a great example. They're focused on the legal sector. Abridge is focused on the healthcare sector. Expo is automating pen testing for cybersecurity. And so those are a few examples. And this is the way we try to make sense of this world. In particular, in the universities, what we've noticed is that a lot of the focus is on hardware and infrastructure. Over time, I think it makes sense for us to encourage folks to focus on the application layer. Next slide, please. Now that we have a framework for understanding the space, I just want to quickly review the state of the fundraising environment from earlier this year. Every year, we typically walk through financing trends that we notice, and so it makes sense to walk through it again. Next slide, please. So in the broad tech industry, this includes software, hardware, and climate tech. It seems that general funding has remained the same. We've noticed that the software funding has been consistent with 2023, but still relatively small in comparison to the boom of 2021. And I think we can assume that most of the current trends are a result of AI and machine learning deals. That's what we noticed across the board, at least in the university sector. So assume it's also similar in the broad sector as well. Next slide, please. Now, in terms of the average deal sizes, we think that this is pretty consistent. So the valuations are quite large due to competition to getting into these deals. And ultimately, most of these folks need to hire, highly talented people, spend a majority of the reserves on GPU usage to train models or to fine tune models. And so we've seen this trend over time that the valuations are just increasing as well as the typical round size. And as I mentioned before, there's been a large consolidation of funding. So OpenAI just announced the largest funding round in history. We anticipate a lot more to come that way, especially as they show progress in terms of near-term revenue. So one thing I didn't highlight before, a lot of these companies are starting to generate meaningful revenue, and we'll get into it in the Q&A. OpenAI is reported to generate about $3 billion in revenue across both their consumer platform as well as their enterprise API usage, and it's expected to increase to $11 billion next year. Next slide, please. Now, in relation to the broader AI investment pool, universities are contributing significantly less, but I think some of this data is really underreported. A lot of the deals that I've seen are, very fast-moving, safe deals. So a $1 million safe at some kind of cap note, and so typically it's not reported. So I think this is underrepresented, but still, there's still quite a bit of movement in the university space. So what's most prominent is a company called Perplexity, which is competing against Google. They're building a new search engine. World Labs is from Fei-Fei Li's lab in Stanford. They're building a spatial intelligence foundation model. They've raised hundreds or so $1 million. So still similar patterns where there's a few set of companies that have driven most of the deal flow, and most of the capital being raised along a few concentrated bets with folks who have strong brand names in the space. So the universities contribute less to the overall funding, but its impact is quite large. Many researchers have gone on to work at Meta, Google, and other places, and then have gone on to get funding as a result. Next slide, please. And so I'm going to hand it off to James, and he's going to introduce himself.
Well, yeah, thanks so much, Ajay, and appreciate the opportunity to come share more about myself in First Round. So some background on myself, I started my career doing machine learning research about a decade ago at Duke University, and I got to see the first GANs paper get published, got to see Google release TensorFlow, and it was a really fun time to kind of enter the space in the industry. And you can see I still sometimes call it machine learning, which shows I'm a bit outdated nowadays. But in that time, I also spent time as an engineer at a couple of startups before deciding to make the leap to start my own company, AdaptLab. And so I ran that company for about 3.5 years, 2018 to 2021 as the CEO and co-founder, before selling it and joining another startup, which was a Series D unicorn called Imperity, to lead their ML team. And I was there for about a year, but in 2022, I realized I really started missing early stage startups again. And so at that time, I decided to join First Round to go back to the early stage. And I've been there about 2.5 years now, focusing corely on infrastructure and AI investing. Next slide, please. So a bit more about First Round. We've been around for 20 years. We're focused on early stage pre-product market fit investing. And what that means practically is we tend to lead pre-seed and seed rounds from anywhere between 2 to 10 million. We have offices in San Francisco, New York, and Philadelphia. So very friendly with OUP as well. And I've gone to meet Ajay in quite a few deals now. And we've been investing in machine learning applied to many different domains for over a decade. You can kind of see in the AI bucket there some of the early wins in our portfolio, Verkada and Upstart, which were applying, Verkada applying computer vision to cloud located cameras, and Upstart applying machine learning to better lending. And obviously together, one of the more recent companies, the Gen AI Batch. So we've been really focused on investing in AI and infrastructure over the last few years. And I can share a bit more about how we think about that. Next slide, please. And so this is just a high level kind of umbrella map to get a sense of how we think about the market. It's obviously not all inclusive, but broadly the application layer, the tooling layer, and the infrastructure layer, and the different there are different opportunities to invest in each of these sub buckets. If we go to the next slide, I can talk a bit more about how First Round has been thinking about that. And so we give some examples. The color coding is a bit complicated to figure out, but broadly, if it's a blue color or a dark black color, those are all first round investments. And then some of these grayed out names are just well-known companies in each of those spaces. You can see the AI application bucket is by far the most filled. And I think broadly, we see a lot of opportunities at the application layer to continue to compound value and build a longer term moat. But that doesn't mean we're not going to invest at the tooling or the infrastructure layer as well. In the last few years, we've made a lot of investments specifically in LLM related dev tooling, and actually AI applied to BI tools as well. And of course, in the terms of the core infrastructure layer, I think there's always evergreen opportunities here. You've seen different cycles of databases get created. The new stack of model and inference provider is a really interesting investment opportunity, which I'm sure we'll talk more about. And some of these other core functionalities like modern data stack and observability have been around for a while. Next slide, please. I think we'll talk more about this in the questions, so I won't go through all of these, but wanted to just share some of the areas of opportunity we've been seeing, specifically across different application areas, and obviously bucketing like dev tools and security here into an AI-focused application, just targeting an end technical user. But we'll dive more into this into the questions. So if anyone has any questions about this, please hop in. Next slide, please. And wanted to just give one more context around pre-product market fit investing. So broadly, when First Round was created, it was focused around this idea of helping founders at the earliest stages before they've really figured out like working products, the right problem to go after, or the right market to go deep into. And one of the ways we started doing that was this new program called PMF Method. The URL is pmf.firstround.com. The reason I'm giving it a shout out is we've done 3 cohorts now of the PMF method over the last couple of years. And in every cohort, we've had a couple of university researchers who were spinning out their research to kind of join this program and learn more about the business side of building a startup, and just like the iterative process of taking some core fundamental technology and transitioning it into like a working commercial business. Next slide. I hand over to Jordan.
That's awesome. It's a hard act to follow, but I'm excited to be here today, and can briefly introduce myself. If you don't mind, go to the next slide, please. So just my quick background. I started my career in investing at a firm called Bessemer Venture Partners. Was there sort of before this recent AI revolution, but focused actually quite a bit on machine learning and different ways of applying machine learning in industry. Then went to business school at Stanford, where I met 2 different companies that I ended up working with. One called Evolution IQ, which is actually a first round capital company, James probably knows well, which is a company that uses AI to provide guidance around claims for insurance companies. And I was the first employee there and led product. And then joined a company called Snorkel AI, which was a spin out of Stanford's AI lab. So very, very excited about university spin outs in general, especially given that experience. I was the first kind of business hire there, and ended up leading finance, biz ops, and a bunch of areas of strategy. I was there for about 4 years. And then about a year ago, joined A-Star, which is the early stage venture firm that I'm an investor at. And I think I sort of added a fun graphic to the slide to show. I think most folks that end up in venture roles, I think James and I are good examples of this, have often pretty winding paths to end up in those roles. And in both of our cases have had the privilege of working at and with some great companies. And then can talk about A-Star on the next slide, just to give a brief overview of who we are. So we're an early stage venture capital firm. Our primary focus is on pre-seed and seed investing, and we can talk more if there are questions sort of around what that means specifically. But typically, it's the first check in a company. Just kind of going down what our strategy is. That's our focus is sort of the first check, being the first investor, working super closely with companies. We're very conviction driven in what we do. We are founder first in everything we do. And the reason that we typically decide to invest in a company is because we think that the founders are exceptional. And so we work hard to build relationships with those founders and understand those founders and have conviction in those founders. And we prefer to, make a commitment early to those companies. In terms of areas we focus, we're actually very much generalists. So we spend a lot of time on AI today, like most folks do. But we are, again, very focused on founders and think that founders bring us into the best at new markets. So we've been active in quite a few areas outside of AI and can talk more about that if that's interesting. And then the last piece is that we work really, really hard to provide value to our founders early on and spend, we invest in a handful of companies only every year and work very closely with them. And then on the next slide, this is going into a little bit around how we think about AI. And I think Ajay might have some questions around this, and we can talk more about it if it's interesting. But I wanted to share, a couple thoughts here. We've done some work recently on looking at AI in the context of history, which we think is often quite instructive. And one of the interesting topics that often gets brought up in settings like this, and folks that are thinking about starting companies is, where should I found a company and where are their opportunities? And one of the axes that we think is interesting to think about goes back to actually both what Jay and James said in terms of how we think about market structures. One of the breakdowns is sort of infrastructure layer versus application layer. And so I wanted to share, this as just a starting point of kind of how we're thinking about things. We spent time looking at, the last two quote unquote platform shifts of cloud and mobile. And I think it's very instructive to look at where value has accrued over those platform shifts. And the first thing you may notice in each of these is, so on the left bar, just to sort of get our bearings, on the left bar, the black bar is infrastructure. And on the right bar is applications. And so we looked at during each of these platform shifts, where did value and market cap accrue? And the first thing you'll notice is the infrastructure bucket is bigger. But if you actually zoom into where that value accrued, you'll see that the vast majority of value accrued to incumbents when that platform shift happened. So when the cloud platform shift happened, value accrued to Amazon, Microsoft, Google. These companies had been around long before the cloud shift happened. The vast majority of value accrual at mobile happened, went to Apple, which had been around for decades and decades before the mobile shift. If you look at the application layer, it's slightly smaller in terms of the value that was built, but they're all, for the most part, new companies. And we think that there's this massive opportunity that happens at a platform shift where the experiences that need to be built are net new, where incumbents often have, innovators' dilemmas, and we can talk more about what that means and entails. And where really there's opportunities for companies to move fast, iterate in a capital light way, and build incredible new experiences on top of these platform shifts. So we're really excited. We've made investments. We're excited about the infrastructure layer in AI, but we're really, really excited about the application layer in AI. I think there's going to be a lot of opportunity, now and for likely a decade plus to come in terms of building new applications and experiences on top of the awesome infrastructure that's being built. So preview into probably what Ajay will have us talk about shortly. And that's a quick intro into myself, A-Star, and some of our early thoughts on AI.
Great. We'll head off into the Q&A. I think there's a great segue from an audience question that I'll tackle on first. So Jay mentioned that universities will be shifting from the hardware and infrastructure layer to application layer. Typically, the software that comes out of the universities is not commercial grade. What are you looking for when evaluating AI applications that come out of the university? And what type of IP projection do you hope to have for these applications?
I'm just reading the question. James, you want to start?
Yeah, totally. I think it's definitely true the software is more at a research state when the founders come and pitch, especially I think at the stage Jordan and I are looking at. I'd be curious, Jordan, to get your take specifically on Snorkel, given you were kind of there in the spin-out phase. But I would say broadly, for us, the question is not so much around whether or not there's a already working piece of commercial software. It's more like, is the technology uniquely differentiated, or is there a path to commercializing quickly in the enterprise? And like how much education does it take to get an enterprise using this piece of software. And that could be a much better framework in terms of how it's packaged, or just a very heavy go-to-market motion where the founders are doing a lot of the education.
Yeah, I couldn't agree more. I don't think there's an expectation at seed or pre-seed investing for there to be a completely commercial grade piece of software built, especially in the settings we're talking about of spinning out technology from university. Honestly, the reason that Jay, James, and I each have jobs is because our job is to provide capital to companies to go hire teams. And often getting to commercial grade requires hiring great teams. And so, I think the expectation, just as James said, is that there's some unique insight, that there's some technology that you built that you're excited about, that there's something you want to build and get to commercial grade. But I don't view having, production ready software as a bar to, start thinking about building a company.
Yeah, and I'll add from my perspective. I think it's important to do a lot of customer discovery work. So, there's like the National Science Foundation grants to be able to do customer interviews. And as you're exploring different verticals, I think one of the things we look for is like, are you able to recruit subject matter expertise in that specific domain? A great example is, hey, I have this unique infrastructure tool that's better for agents, but I think it's uniquely suited for SAP, for example. Well, that's a great discovery. You talk to a number of customers, but you've also been able to recruit a subject matter expert in that space. And that's what we look for, even if the technology is not production grade. Great. So we'll head off to the other questions. So something I've been thinking about for a while. It's this space has moved quite fast. It's been 2 years almost 2 years exactly since ChatGPT has released, and it's sort of changed the landscape. I think we've known that the development of NLP has always been there in this space, and there's been a number of different hype cycles, whether it's computer vision or otherwise. Things have moved pretty quickly. So from both of your perspectives, like how has your investing style changed over time, and what have you learned from the experience so far?
I can take a first crack here. And I think the infrastructure landscape that I shared, or sorry, the AI market map landscape that I shared is a pretty good answer to this question as well, where, in 2022, even pre-ChatGPT's release, but when LLMs were kind of taking the stage again, we were doing a lot more infrastructure investing, right? Almost like the picks and shovels investing that you would expect to kind of enable this next wave. Nowadays, I'd say probably a large portion of our investments go into companies at the app layer. And that doesn't necessarily mean they're just, building on top of foundation models purely. Like, there could still be really interesting technical innovation at the app layer. But broadly, we're seeing more companies being built at the app layer, and then we're also seeing more investments being made.
Yeah, I very much agree with that. And I think, like, when ChatGPT first came out, I wasn't investing. So I have about a year of sort of post ChatGPT experience. When ChatGPT came out, I was at Snorkel, and it was really cool and interesting to be at the heart of working with some of the biggest, companies, banks, insurance companies, as this explosion of interest and attention to the promise of large models, large model-based AI happened. And I think, and so again, sort of the context I have in terms of how my investment and ours a firm investment strategy has shifted is in a narrower window. But I very much agree with the point. I think early on, a lot of excitement around big gaps at the infrastructure layer, because those gaps did exist. There were not interesting production grade tooling for lots of different things that you'd want to build in AI. And I think now if you were to do a mapping of the stack and say, hey, where are the gaps are few and far between. There are great companies that are being built at pretty much every sort of area of tooling or layer, depending on sort of how you map things out there. And it doesn't mean there aren't opportunities to build new companies. There absolutely are. I'd strongly hypothesize that over the next year, many, many interesting infrastructure companies are going to be built and founded. There's no question. People will find gaps. People will build great companies, but there aren't obvious gaps right now that you can sort of do a mapping and be like, hey, we need to go find the eval company, because there's a bunch of great eval companies out there that have been funded, and on and on and on across the stack. Across the application layer, it's a much broader world. And the timing is such that now that the infrastructure layer has gotten more mature, there's this opportunity to build at the app layer, which I think is really exciting. And so again, kind of reflecting what James said and what I said up front, like we're spending quite a bit of time there. I'd say the other thing that from a, my perspective has changed is making sure we're understanding and focused on the durability of products and revenue. I think particularly in Gen AI, there's so much excitement. And I'm talking here more about the app layer, but it applies to the infrastructure layer as well. If you go into the enterprise, like there's so much excitement from folks to try the next tool and try the next great thing. And a lot of folks have mandates from their bosses to like go find an AI solution to what we do. And so it ends up with lots of companies that have non-durable engagements with companies and buyers because there are a lot of folks tinkering. And I think over the past year or 2 years, like we've seen more and more of like those engagements play out. And sometimes they work if you have a great product and sometimes they don't, but you can have some of these false signals early on because of all the tinkering that's happened. And so where my focus has been also is just on making sure that the products that people are building that we're considering investing in and partnering with are great, that they add true value, that customers are seeing, value and success out of them. They're solving a real pain point. We can talk more if it's interesting about sort of like how we evaluate some of those things, but more and more of a focus on that, I think, has been one of the ways that my thinking has evolved.
Great. I would say like that's a huge shift in this wave. Ultimately, the fact that there are potential buyers and I think within the enterprise in particular, the higher ups understand the value because they've used the tool itself, and so therefore they're supportive in terms of budgets. But I think you bring up a good point. So now for 2 years, are you seeing true enterprise budgets devoted to production use cases? Or is it still in experimental mode?
I can give my quick thoughts there. Is it totally depends on the area. I think there's certain areas that are seeing like real production budgets because they're seeing real ROI. Um, Customer support and service, it's code gen. Um, Actually, those are two that come to mind as like some of the biggest areas of spend where there's like real value and real production budgets. And there are other areas that are just much earlier. The companies that are building products are younger companies, products are earlier, and they're still having to prove ROI. So I think it's a lame it depends answer for me.
Yeah, I have maybe a fun anecdote on this. I completely agree with Jordan, where there are a few areas where it's already clearly established, like code gen, customer success, maybe now sales as well, like the automated SDR type application. But broadly, I think, we ran a survey of a bunch of VPs of engineering earlier this year at scale companies that have been shipping machine learning applications to their users for at least a couple of years. And broadly, the number one reason folks were exploring, Gen AI initiatives was net new revenue opportunity. And then 2, 3, and 4 were all some form of board pressure, executive pressure, or market hype, right? And then number 5 was customer demand. And so that was kind of like a fun anecdote for us where there's clearly interest from the enterprises. I think in that survey, we got this context that HSBC, which is, this large old school bank, had done 500 POCs with AI application companies in the last couple of years. But I think it's still early to figure out some of these other like really sticky workflows or applications that are super valuable, like the customer success, like the SDR, like the code gen. And so I think we're going to eventually see the shift where like number 1 and 2 are net new revenue and customer demand, but I don't think we're quite there yet.
Great. And so by extension, when you're conducting diligence on these Gen AI companies, whether they're app layer or not, in general, to build off of that point, what type of traction are you seeing across the board? And how are you diligencing this? Is it about retention? Like how do you decipher what's a real market need versus experimental hype?
It's hard, candidly. I think the most important thing to do always is talk to customers. Like there's, data is obviously interesting, and you can say, hey, we have X N customers or X revenue, and that's awesome. And that typically does tell a really interesting story. But I think the way that you get one layer deeper is talking to users and customers. I think it's what founders should be doing. And I think it's what investors should be doing, to understand where their product is, what is the maturity, who's getting value out of it. And so, like, there's lots of different ways to do diligence. For me, it almost always comes back to users and customers, though.
Yeah, absolutely. I completely agree with that. I think as long as you believe the tech is feasible or the product is, feasible and it can generalize, then it's really a matter of, going out, hopefully talking to the existing customers of the company. But if they don't have those yet, finding what their ICP, which is, their ideal customer profile, and finding folks that would fit that. And just, sharing your own description of the idea and getting their take on whether or not it'd be useful.
To build on this thread, historically in SaaS terms, when you first make an investment, you look for a great team, then you move forward and you find some resemblance of an ICP. Then at the Series A, you're targeting about 1 million AR. Have you all determined what the benchmarks are for that inflection point at this stage for Gen AI startups? Or is it too varied across the board? And what type of traction are you really seeing within let's say, the top percentile?
I think it could vary a lot. Again, like at the app layer, a lot of these companies are starting to look like traditional B2B SaaS companies, but with AI being the core feature. And in that sense, the framework you just gave, Ajay, is a pretty good representation. And maybe there's a bit more hype and enthusiasm. So rather than raising at 1 million, they're raising at 500 to 800K ARR. But broadly, I think we're starting to see a very similar repetition there. At the infrastructure layer, it's very varied. I'd be curious to hear what Jordan thinks.
Yeah, I totally agree with that. I think there's competing factors. I think there are things that are driving companies to raise earlier, and there's things that drive companies to raise later. So driving companies to raise earlier is the hype cycle, right? There's demand. People see a great team, people see a great product. There's a lot of investor demand for, hey, first round went and led your seed, and everyone knows first round's an amazing investor, and so now folks kind of have signal it's interesting, and they spend time with the team, and they see it's an amazing team and product. They're like, okay, you're not quite at 1 million ARR, but we're going to sort of front run everybody and try to get in early, and so you see that company raise earlier. And so you absolutely will see companies raise earlier, especially in this type of hype cycle than typical. But driving companies to raise later, I think, is there's so much demand for AI-based products, and some of these are tinkerers, that it's not uncommon now that we're seeing companies go like 0 to 3 or 0 to 5 or 0 to 10 million of ARR. It's much more common now than it was pre-AI, at least in terms of the data points I've seen. And so a company might not have time to raise another round of capital if they're in 6 months, going to $1 million of revenue or a few $1 million of revenue. And so they might not feel the need to raise capital as quickly. So you might see them raise later. The other thing I think you might see is, there's new models, there's new commercial models. And one of the commercial models that's getting a lot of traction is around, service as a software, providing, tech-enabled services or sort of full stack solutions. And the ACVs, which is the average contract, the annual contract value, or ASP is the average selling price, like different ways people talk about this, but the contract size is often bigger because you're delivering more value. And so you might see companies scale more quickly because they have these very high ACVs, which is another reason that companies may choose to raise a little bit later, because for them, they still want to get 5 customers or 10 customers, and they end up having a little bit more revenue because the contract sizes are bigger. So I don't have a good answer to like what's the number that we're going to shake out at like the new AI Series A. I think there's competing factors.
Right. And that's a great segue to an audience question. So I think we all recognize that there's a hype cycle now. There's potentially a bubble. And so the audience member asks, like, what do you worry might drive a bust in these evaluations in AI, and by extension, like, how do you stay disciplined as an investor in this time?
I think it goes back to what we were saying earlier with the customer demand, right? If you listen, even at the largest public companies like Jensen talking about NVIDIA, his belief is that there will be more inference than anyone can imagine. And consequentially, there will be more AI applications than anyone can imagine. I think where people are betting on, the people who are investing very heavily into this hype cycle or into this potential bubble, is that these AI applications will dramatically change how we do work today and across many, many domains that we haven't even thought of. And if there isn't that demand or there isn't the budget to spend on these types of applications, that's when we're in like a big disconnect.
Could not agree more. Like I think it's all around reality versus expectations. When a company releases their earnings, if they say we earned $2 a share this quarter, all that matters is whether the market expected them to have earned $1 a share or $3 a share, and that's what drives sort of prices and busts of prices in markets. And prices are high today in AI because there's extraordinary expectations about the value that can be delivered. And so all that matters, I think, is, and I'm just repeating what James said more eloquently than I did, but is, will that value be there? And if that value is there, I hope and don't think we will see busts. And if the value ends up not being there and there's vaporware being sold and companies aren't getting value out of it, that's when we would see a bust.
Right. Taking a step back, you both have highlighted that your areas of investment now on the application layer, but still open to some infrastructure investments as well. When you evaluate teams, what do you look for? Like what qualities? Is there a specific background that you prefer over others that are uniquely capable of harnessing this technology? And Jordan, we can start with you.
Great. I think I generally look for two things always in founders. One is they're just world class in everything they do, period, sort of regardless of what they're building. Brilliant, hardworking, run through walls, persistent, demonstrated history of success, whether it's academic or professional. We can go down a list of amazing adjectives I can share, but we're looking for folks that are amazing founders, regardless of what they're building. And the second thing we're looking for is, what we often talk about is founder market fit. Is the founder building in an area where it makes sense for them to build? That there's a good reason for them working on what they're working on? Do they have a particular insight that's unique that other people in the market that are trying to build this don't have? Do they have an unfair advantage to win in this market? An example in university spinouts might be you've spent 4 or 5 years doing research, and you're one of the world's experts on something. I think that's an amazing answer for founder market fit, and particularly unique to academic settings. Which is one of the reasons I think OUP is such a cool firm and ends up doing such cool investments. So that is, it's a simple framework, but that's kind of the framework I think about. Are they awesome, period? And are they building in a space where they have a right to win?
Totally. I would just echo everything Jordan shared there. I think a lot of the key attributes for a winning founding team at a startup doesn't have to be specific to infrastructure or AI, right? It's just broadly this strong desire to win, grit, commerciality, good strategic chess playing in terms of how a market plays out, right? A lot of these are generalized to consumer founders or B2B SaaS founders. It doesn't have to necessarily be infra or AI. And I think that actually helps in terms of the underwriting because those are patterns that have existed for a very long time. The only other thing that I think is really interesting, again, specifically when you're investing in kind of university spinouts or like core fundamental research, is you have this concept of like the N of one team, where it might be possible this is the only team in the world or like one of 5 teams in the world that could actually solve this technical problem. And that obviously gives you a good head start in terms of building a moat in the business or just scaling the business really quickly.
Great. And that's also a good segue here. Things are moving pretty fast in the space. There's a new paper that's released every week about some new breakthrough. I think last year in particular, there were a number of new models that came out that sort of changed everything from GPT-4 to Claude 3, et cetera. So how do you both stay current on the latest trends, and ultimately, how do you conduct technical due diligence on things that are, all very new? James, you can go first.
Yeah, it's tough. When I joined First Round in 2022, I did not expect I would be reading as many papers as I do now. It's almost like dusting off some of my time doing research back in the day. But I think like the easiest is really just kind of going to conferences, staying relevant, chatting with the folks that are actually, discovering the research and building. And then I think the next best step are like these cutting edge AI application companies or infrastructure companies that are applying the research. And they might not be the ones inventing the new model type or something like that, but who understand why the framework or the fundamental research is interesting and can apply it to a new domain. And so broadly, I don't think at least I don't have a shortcut. I would love if there was one. But just spending a lot of time with either the core research and the papers that are being referenced or the actual teams that are using the research first or creating the research has been helpful for me.
Once again, I'll echo James. Like, I think reading papers, I think there's obviously lots of good resources to aggregate the papers that are, have particular breakthroughs, and the papers everyone should be paying attention to, their blogs, their, X accounts. Like, I think we're all probably paying attention to the same ones, and those are extremely helpful resources. And then, I like to try to surround myself with people much smarter than me who can kind of share what they're interested in and guide me to areas that they think we should be paying attention. And I think diligence is quite similar to answer the second part of that question, which is, especially for deeply technical diligence, we rely on experts. Those experts might be in our network. Those experts might be folks that work at companies that we've invested in. Those experts might be in academia and relationships we have. There's lots of sort of pools of experts that we try to tap into, but I don't think there's a good alternative or substitute for talking to the folks that know the space best. When we're making an investment, especially in something that's at infrastructure or technical, definitionally, we're supposed to be investing at the cutting edge. And so to understand the cutting edge, you typically need to talk to people at the cutting edge. And so we try to find those people.
Great. We've also talked about growth rates and traction, and this industry has also spawned an entirely new set of business models that have tried to make sense of commercializing this technology, from API usage to some attempt of SaaS or services of software, as you mentioned before, Jordan. Can you discuss the sort of pros and cons of each approach? Is there preference? Is there a preference from investors' context? Now, Jordan, I'll let you start.
Once again, I say it depends. It depends on sort of what you're building. I think there's different business models work really well for different products. And just to sort of share the extreme, if you were building a new drug, a SaaS business model doesn't work, right? And if you're building some new infrastructure, probably services software doesn't work. And so I think there has to be fit between product and business model. I think it's exciting that AI is enabling. Look, API-based business models and metering have been around for a long time. SaaS has been around for a long time now. They're proven business models. They work really well. They're customer friendly. Customers typically like them. They're very powerful financially for companies, and they can drive incredible business profiles for businesses that rely on those types of business models. I think one of the exciting things about AI is sort of what we talked about and what you just alluded to, which is that there's new business models that are enabled, and one that I think folks are excited about. And I don't know who gets credit for these because different people claim credit, but like instead of software as a service, service as software, and the idea of being able to actually provide outcomes and succeed on sort of like jobs to be done that companies are looking, companies or individuals are looking to get. And so, an example would be, if you are building a company in the legal space, you could build a tool for lawyers that allows them to do, better search, or that allows them to draft documents faster or redline faster. Or you could build the AI-enabled law firm that operates using AI in the back end, but rather than delivering a tool to somebody, it delivers an outcome. We solved this case for you. Here's a contract. And that's one very small example. There's a lot of attention right now in legal AI, but that's really exciting. And that can drive more value for customers. It can drive It can drive much bigger contract sizes. Therefore, we think it can probably drive bigger businesses and bigger outcomes as you start companies. I think you have to, again, it has to be the right space, it has to be the right product for you to leverage that type of business model. But that I think it's rare that new business models are enabled by technology, and it's exciting to me and us, and I think lots of folks that's happening with an AI right now.
Yeah, totally. I think Jordan gave a really good description of kind of the whole landscape. The two things I would add, maybe just two of the example business models that have kind of evolved that we think are really interesting. There's this new concept of like outcomes-based pricing, right? And so again, specifically tying a payment, it's like an extension of usage-based pricing, but you imagine you have an AI to resolve a customer success ticket. You only get charged when that AI successfully resolves the ticket. Whereas in the past, a usage-based pricing structure would be however many tickets go through the AI system, that's how you get charged. And then like the previous version of it would have been however many reps you have receiving those tickets, that's per seat pricing. And so you charge per rep. And so anyway, I think outcomes-based pricing is really interesting. And then the other thing we've seen that's kind of an extension of this service as software concept is like the AI bootcamp installation. I think Palantir made this quite popular, but we're seeing a lot of enterprise-facing startups doing this as well, where you're really like on site doing a heavy educational movement, on-prem installation. The boot camp is a 1 to 2 week process with the founders really teaching a lot of the employees at the company how to use their software and also doing the direct installation. And that, while there's definitely a services piece to that, that's quite, time expensive and not great margins. It makes the rest of the product so sticky. And so that's another one that we're going to keep looking at. That seems pretty interesting.
Yeah, I want to add, like, it's more of a comment. I guess the truth is we don't know how these business models will be valued in the future. And right now, it's quite preempted. And so it'll be interesting. Like historically, a recurring business model that is guaranteed tends to be valued by investors over time. But Palantir is a counterpoint to that. And so maybe that is the go-to standard for the future. And clearly, they're a highly valued public company now, and they've proven out the model. So it'll be interesting to see what happens in the next 3 to 5 years.
Yeah, I totally agree. Just one thing to add to that is like I feel like SaaS has be such a powerful business model for two reasons. One is high margin and two is sticky. And I think what's exciting is some of these business models have the opportunity to have both of those, even though they're not SaaS.
Yeah. Great. And then, something we hadn't talked about yet. So how are your firms thinking about exit opportunities? Ultimately, our job is to deploy capital, but also to return capital to our investors at some point. And so with the recent number of exits from foundation model companies like Adapt, Covariant, Character, how are your firms hypothesizing potential exit opportunities for your Gen AI investments?
Yeah, for better or for worse, we have not invested in a foundation model builder. And so I think we've watched, the Character, Adepts, Covariant, Inflection acquisitions with a lot of curiosity. And I think it's a clever way that these teams have figured out how to get around the M&A lockup right now. But I don't think we're reading too much into it. Broadly, as investors, our end goal is we're hopefully investing in companies that IPO or that sell for billions of dollars to a much larger public company. And I don't think there's been that much shift, at least in our side, in that underwriting, just because of how early we are in the AI wave. I would say, I guess, like the Character, Inflection, Adept, Covariant outcomes are maybe making us a bit more wary of investing in foundation model providers, but I think there are also a bunch of reasons to be wary and to be excited about them in the past. That hasn't changed.
Yeah, I agree. And I don't think there's been certain examples, but I don't think there's been broad-based data to suggest that the exit environment for AI companies or generative AI companies is going to be sort of a paradigm shift from what the exit environment has been for tech companies for decades. I think it's just too early to know.
Yeah. I hypothesis part of it is like margin profiles, like the cost of building these models are enormous, especially if you don't achieve product market fit. And so I'm curious, like with the application layer businesses, are you seeing better like margin profiles? Like, have they gotten the cost of inputs down to a meaningful amount where it's similar to pure SaaS margins, or there's still a ways away to go? And Jordan, you can start there.
I mean, things that I think drive down margins for AI companies are um, if compute's super expensive, um, and B, or sort of like API layers, foundation stuff you have to rely on. Like if you're relying on an expensive voice model or something like that, like there's reasons that margins may be at the gross margin level may be driven down. The other is, some of the stuff James was talking about in terms of the need for services early on, right? And I don't think that's an issue. I just think it shows up in the P&L as lower margins. Um, but I think there's a lot of reason to believe that, AI-driven businesses are going to be extraordinarily healthy margin businesses. And a lot of the tooling that those companies, that AI application layer companies rely on are driving margins up for those companies, just like they're driving margins up for any company. So, who knows where like, gross margins and EBITDA margins and cash flow margins end up settling. I think AI most likely across the board is going to have a positive effect on margins. Um, uh, but yeah, I think the two things that we're seeing sort of like initially at least drive down gross margin level is sort of like spend on compute and API layer stuff. And then any services that needs to be done.
Yeah, I think the pricing pressure we're seeing from the foundation model providers on APIs is actually a really interesting dynamic at the moment. If you look at the last wave of machine learning focused B2B companies that were started in 2016 through 2018, those companies all really struggled with getting gross margins above 50%, which broadly the target is 80% if you're building a B2B SaaS startup. And I think partially that was because there was this heavy installation piece. It's because you had things like data drift. So you had to retrain models pretty regularly. You had to think about getting new data and new compute continuously. And I think the fact that a lot of the core foundation model is now packaged into an API that's continuously getting cheaper could be an interesting unlock to finally get some of these like AI first applications to a healthier margin profile. And I think we're still gonna have to wait and see that play out. But I think I was pleasantly surprised when some of these early companies in the AI wave, like Jasper AI, supposedly grew to a lot of revenue with reasonable gross margins. And so, well, it'll be interesting to see what happens with the rest of it.
So shifting gears here, given that we have a university audience, both from tech transfer and the research community, and would love to get your thoughts on where the universities can help enable researchers and founders moving forward, especially in this Gen AI world. So if you could share your thoughts on the impact that university researchers have had, how these institutions can continue to support that research, and would love to hear more. James, want to start?
Actually, I'd love to hand this question first back to you, Ajay, given you spend more time with these university companies than Jordan and I do, and then we're happy to append after. But I think you would have the most thoughtful answer here for sure.
Absolutely. Yeah. So I think the underpinning of this technology has clearly been influenced by universities from Jan LeCun to others who have joined exceptional research institutions like Meta, Google, and others. So the universities have had an outsized impact on this world. And I think the best way to support them and to encourage them to stay in academia is to provide the resources that they need. Ultimately, right now, the biggest resource is compute, and it's a scarce resource at the moment still. And so I think if the institutions can find ways to offer access to GPUs and servers to be able to train and test the models and the experiments that the researchers are conducting, ultimately that'll prove to be a symbiotic relationship. Oftentimes, the primary questions for researchers, whether they're joining a startup or otherwise, is how many GPUs do you have? I have to run these experiments. And so I think like ultimately a lot of the mind share is still at the university. They're being recruited heavily by these for-profit institutions like Meta, because they have not only the opportunity to like earn a high salary, but also access to GPUs, which is ultimately what they care about. They want to be able to conduct their experiments and to transform their ideas into reasonable impact. And so my recommendation is to continue to support them through simply from resources, and ultimately, help connect them with investors like ourselves to translate those ideas into commercial startups as well.
Yeah, totally. I think compute is like a great answer, Jay. And I think that's probably the number one thing. Maybe the only other thing to double click on is really the recruiting piece. Like we've seen a lot of these AI labs or even, just like deep tech AI applications really grow effectively by, kind of cornering a specific type of talent at a specific university. And that could be like, Snorkel hiring a bunch of really great Stanford folks, right? Like that kind of dynamic. That I think if universities can help catalyze that, will just continue to help these companies grow.
The only two things I'd add on, one is just an echo of like universities have been so unbelievably critical to all the innovation we're seeing. And if you trace back the lineage of almost any breakthrough that happens today, some core part of that happened at a university. And so I think we all owe quite a bit of thanks to academia and to universities for the exciting stuff that we're seeing today. The second thing in terms, Ajay, you said sort of meant connecting folks with investors. I also think connecting folks with industry. Especially if you're building at the application layer, presumably you're either building for consumers or you're building for businesses. And getting in touch with consumers is often easier because you can talk to your friends. Getting in touch with businesses that you want to build for is harder. And I think universities have great opportunities to be conduits and bridges to connecting folks to industry where they want to be building solutions for.
Yeah, that's also a great segue. So, Jordan, a specific question for you. You were involved in an early stage spin-out Snorkel. You were the founding business hire. How did you make that? How did you help them make that transition from, open source utility to commercial grade product with early customers, and I assume many of which are enterprises? Like, what were the lessons that you learned during that time? How did you help them achieve product market fit? And what resources would have been helpful to know at the beginning of the journey?
I could do an hour on that. So I think you said sort of how did I meet them? So I got introduced to the team while they were still in their PhDs. And I was at Stanford in grad school. They were at Stanford in PhDs, and one of the founders was in his master's. And so I, kind of met them and built a relationship with them while they were kind of wrapping up their academic programs. And Snorkel at the time was an open source tool focused on programmatic labeling. It's much broader now as a company. But that was sort of the context. And you phrased a bunch of those questions in terms of like, what did I do? How did I help them? I was a very small part of a journey that was led by an incredible founding team that was all out of Stanford, as you mentioned, and all out of Chris Ray's lab. So Chris Ray led the lab. Chris Ray is a serial entrepreneur and runs an incredible lab at Stanford, where the Snorkel research came out of. And then, the other co-founders, Alex Ratner, Henry Ehrenberg, Braden Hancock, Paroma Varma, were all spectacularly talented, all incredible researchers, but also I think had a deep understanding of customers, of how to be commercial, had done a lot of work even during school of working in industry and understanding how the technology fit in industry and how to build it out. So the answer of like, what did I do was very little. What did they do, I think is the question. And, in terms of finding product market fit, in terms of, spinning out and creating something that was larger and more commercial in nature, I think the number one thing we did was spend a lot of time with customers, understanding what their needs were. We had a structure where we worked early on with design partners. And I think design partners, that structure is basically you sign up someone who would be a potential customer for you to be a partner to you as you build. and you're sort of promising to provide them technology or product, and what you're getting back from them is constant feedback around how do you build that product or technology to be a good fit for what solving their problems. And so we leveraged that early on. It was extraordinarily powerful. It helped us get to a product that we thought and proved out and was validated was a great fit for the types of customers that we were working with. So kind of goes back to something I said earlier, which is like time with customers and listening to your customers. And I think that was the number one unlock we had as we spun out of university, and it was sort of in a technology phase to company that had a product.
And we've alluded to this fact of connecting, let's say a research idea, something that an engineer has built with a problem that is actually pervasive in the market, whether it's a consumer or an enterprise. And so, what advice do you have for those folks who are not particularly used to connecting with those customers to be able to get that skill set? And what has helped you both in the past ask those questions? Jordan, you were the first business hire at Snorkel. James, you were a founder previously. Like, how did you both get better at this? Like, what are the tips that you would offer for those who are more technically inclined? And James, you can start first.
Yeah, broadly, I think so there's a lot of frameworks and ways to go about doing this, and just like very tactical learnings like you can figure out, there's a lot of stuff online. First Round publishes a lot of stuff as well. I'd say broadly, the most important thing is the willingness to do it, right? And being very focused on wanting to get the reps in with customers, doing dollar-driven customer discovery, really thinking commercially about the business, not just purely on the technical side. And I think, First Round, at least, our thesis is we'd rather back product builders and teach them to sell than, back sellers and teach them how to build products, right? And so broadly, I think we believe all of this is learnable. It just takes kind of the right set of awareness, content to kind of study and like reps and going forward from there. And like could definitely spend a ton more time talking about the core tactics of it, but happy to do that offline or in a separate conversation.
Yeah, I agree. I think there's a lot of tactics. It's something that I strongly believe with what James just said is right. Like it can be learned. I don't think there are some people that maybe it comes super naturally to, but for most people, it takes a lot of practice. You have to do it. You have to iterate, do it again. We often talk to teams that spent, as they were figuring out what they wanted to build and how they wanted to build it, they would have like 500 customer conversations. Like these numbers are big. And throughout that process, there's a lot of opportunity to iterate on how you do it. And then the only other thing I'd say is like have confidence as you do it. The folks that are sitting in this room are, I would guess, universally very, very smart and have done really interesting things. And you have a lot of value to add to the person that's sitting across the table from you and that you're talking to. And so, believe that and have confidence as you go into those conversations because they're often very, much more often than not, I think they're excited to be in the room with you and learning from you.
Yeah, I think all of us personally have had to grow in this skill of communicating, especially when your underlying motive is to sell something. It's not always the easiest thing in the world, and it's definitely a skill set that can be learned. And I think all of us in our jobs have worked very hard at it. Oftentimes, we're talking to folks that are much smarter than ourselves, and we're trying to understand their underlying technology, and we have to ask a lot of simple questions. And it certainly hasn't been easy for me, and I think we've all gotten better at it over time. So a few more audience questions, and then we can wrap it up. So some of this may be a little bit out of order, but in terms of application layer items, what about different sectors? So have you all branched out outside of just purely software-driven industries? So for example, are you seeing opportunities with applying LLMs to other sectors, whether it's semiconductors, computational chemistry, or AI-assisted drug development? And how do you view those opportunities?
I think the answer is yes. Like we've seen opportunities across all the things you just mentioned, and I won't share details of specific companies, but absolutely material science foundation models, stuff in semiconductor design, environmental stuff. There's a lot of interesting, a lot of research and interest in folks building models around weather and the environment. So like short answer is yes. And I think they're all interesting. And I think just like any other business, I think it's about figuring out like how do you solve a significant pain for your customers, right? Not like a nice to have, how do you become a need to have for your customers? And I think that very much applies to the layer of, if it's at the model layer, like some of the stuff we're talking about, some of these opportunities are also application layer things, but at either, it's like, are you solving a real problem and how can you build to make sure you're solving a real problem? But the short answer is very much, I think these are interesting.
Yeah, totally. We're spending time with a bunch of companies in this space, and I think the really interesting piece of it, beyond the model being potentially different from a core GPT-4 model or something like that, is there's a lot of availability to build a moat around proprietary data, right? This is like data specific to chemistry or like protein folding or weather, material creation. Like there's a lot of domain knowledge and domain kind of build out that can happen with this specific space of like investing in deep tech. And so I think it's a great place to be continuing to look and continue to build.
Great. And in terms of providing advice for the researchers who have joined us today, um, you know, this is a hard question to ask, but to the extent that you know or hypothesize, where would you recommend them spending their time today? So let's imagine a recent uh, person who's just joined their PhD program. They're trying to decide what areas of research to focus on, especially within this fast-moving pace. So, like, what would you recommend that they focus on in the next 3 to 5, like, to have an impact in the next 3 to 5 years, in particular pertaining to this AI world?
It might not be the most satisfying answer, but I would say whatever you're most passionate about. I think there's opportunities to apply core technology to a bunch of different applications, and that could definitely be an area of research. And maybe you find you love a particular domain, and you're going to apply whatever new cutting edge model gets created to that domain. Or you might just really love a deep, really hard technical problem, right? And you'll innovate on the core research to solve that technical problem, and likely that problem will be generalizable to a bunch of different industry domains or a bunch of different applications. But I think like the short of it is just whatever you are most passionate about that you can become N of one at.
Could not agree more. Where you have passion, where you're excited, where you're going to wake up every day, like looking forward to building, and where you have a right to win. Like I would, I think folks coming out of universities and academia often have specialties. Like they're often the world's expert at what they're doing, and so you do have a right to win in spaces. Not many people can say that, and so building in those areas too. And then I would just say, like, core to our thesis, and I put it on our second slide, is at A-Star at least, is like we don't want to tell founders where to build. We want amazing founders to tell us where they want to build and where they see opportunities and bring us into new markets. So principally, I don't have out of principle, I don't have an answer to that, except what James and I both said of just like build where you're passionate and build where you have a right to win.
I'm going to take a different approach. I think since I've spent more time in this space, I think we as a society probably need more research into sustainable energy sources for data centers that are the underlying requirement for a lot of this movement going forward. And whether it's innovations on the semiconductor level, or I still think there's opportunity for folks to focus on alternative architectures for transformers and other things to further reduce costs, because I think there's going to be an immense demand on our grid system pretty soon. And so that's my take. I think those are areas that I think are pretty exciting, and they will take more than 5 years to develop for sure. Um, and I think there's a lot of exciting opportunity across the board. So we're going to wrap up here today. James and Jordan, do you have any parting thoughts?
This is awesome. I appreciate being included in this. It's a total privilege, and I'm excited to also meet folks that are building. So I'm sure our emails will get distributed, but I'd love to chat with folks here.
Yeah, totally. I mean, thank you so much. It's been really fun, and appreciate everyone coming to listen and giving us the opportunity.
Yeah. Thank you so much for joining. We just included their email addresses. Feel free to reach out to them and myself. We're hoping to do a few more of these in the next few months. And so thank you both for your time. Thank you to the audience members for joining us today. Hope you enjoyed it. I've enjoyed it a lot and really appreciate everyone's time. Thank you so much.